You're listening to the Good Food CFO podcast, where we challenge the status quo of the food industry, celebrate good food founders who are building businesses on their own terms, introduce industry disruptors, and are redefining equitability. If you're ready to build your financial confidence and join the good food revolution to change the way the food industry does business, you are in the right place. I'm the Good Food CFO and your host, Sarah Delavan.
Sarah, you sent me this insight article from Bain, which is a management consulting firm. And the article is called "So Many Unicorns, So Little Cash." Then I saw a video on YouTube from financial content creator Hamish Hodder that I thought you should watch, and I thought really complimented the Bain article. So I want to dive into all of this with you.
I'm excited to do that.
So the article from Bain starts out by saying, as a business term, the word unicorn has taken a life of its own in recent years. First coined a decade ago by venture capitalist Eileen Lee to describe 39 startups that had attained $1 billion in market value, it rapidly became a badge of entrepreneurial success. Today, however, unicorns are commonplace. Bain research shows that almost 2,500 of the companies founded over the last 20 years have achieved valuations topping $1 billion in the public and private markets.
I think that gets regular headlines, right? But I think what's less commonly talked about is that very few unicorns can actually stand on their own and operate without regular infusions of venture capital. And quoting the Bain article, it states that fewer than 1% of those 2,500 companies that have reached so-called unicorn status are actually generating $1 billion in revenue and cash, which is a truer measure of success. So with 99% of unicorns not generating $1 billion in revenue, it makes you wonder how they achieved that market value.
Well, so this actually leads me to the YouTube video that I mentioned at the start. So Hamish Hodder makes content that is focused on investing and the stock market. And I thought that the story that he focused on in this video was important to add to this conversation because of the clarity it offers around the valuations of businesses like unicorns and the implications it has for good food founders that are looking to leverage debt to grow their businesses. So the video is titled "A Once in a Lifetime Financial Event is Here." And we're going to link to this video and to the article that we're talking about in the show notes if anybody wants to check those out for themselves. But early on, Hamish introduces us to Howard Marks, who is the co-founder and co-chairman of Oaktree Capital Management. Marks is known in the investing community for his memos, which detail his investment strategies and insight into the economy and are posted publicly on Oaktree's website. And according to Warren Buffett, when he sees memos from Howard Marks in his mail, they are the first thing that he opens and reads. So Marks starts off by detailing how for 30 years, starting in the 1980s, the US has consistently lowered interest rates, and that for the last decade, they've actually been at rock bottom. That made it really easy to get money. And companies have had the ability to continually access debt to repay their debt. There was never a need to be profitable. Marx even says, nobody ever repays their debts. They just refinance it.
I'm going to stop you here because when I heard this in the video, I had to pause it. It hit me that this is not how small business founders approach debt and repaying debt, right? We have it in our minds that when we take on debt, we will pay that debt down. And if we need more debt to grow the business more, then we'll take on more debt. But I think it's less common for people to think, well, I'm just simply going to essentially refinance my debt over and over and over again.
Well, he continues by saying that when you go through a period when it's super easy to raise money for any purpose or even no purpose, right? And then you go into a period when it's difficult to raise money, even for a good purpose, that many companies are going to flounder. Bankruptcies don't happen just because a business is unprofitable. It happens when an unprofitable business is also unable to raise capital to cover their losses, which Mark says sounds like the same thing, because who's going to lend money to a company that's consistently burning cash? But for well over a decade, a lot of people have actually been willing to lend money very cheaply to companies that don't earn any money.
Right.
They're called zombie firms.
Oh my gosh.
These are businesses, Mark says, that are consistently not profitable, but they survive because they've had easy access to money to pay off their old debts. And that in fact, 10% of publicly listed companies are considered zombie firms.
I mean, that begs the question, are 99% of unicorns then technically able to be defined as zombie firms?
Yeah, it kind of sounds like it, right?
Yeah.
My big takeaway from all of this, from this conversation, is that we're entering a period where it's going to be difficult to raise money. So businesses will have less access to debt to fund their operations and their growth. And I think we're going to be seeing fewer zombie firms and unicorns. So this really brings me back to your point about refocusing on what startup success really looks like.
Yeah. And I think in addition to fewer zombie firms and unicorns, I think what Marx says about more businesses floundering is going to unfortunately also be true. He gave an example in the video about how when interest rates were at their lowest, you could borrow like $800 million at a 5% interest rate. And now that same company might get $500 million at an 8% interest rate. And so if you were a business who was getting new debt to fund old debt, you have a $300 million shortfall in terms of the amount of money that you need. This is a lesson for founders listening, that even if you didn't have venture capital funding before, which again in the headlines is like drying up and we're all very aware of that, it's also true that other forms of funding and debt are becoming harder to come across. So that's a very, very important thing to obviously take note of. Less access to capital aside, because there are many founders who never had easy access to capital of any kind before, I think the bottom line is that profitability and cash have always been the signs of a successful business and are what allow a business to stay operational for as long as it wants to be, right? And so that brings us to today's episode, where we're talking about how to identify the factors that are impacting your cash flow, and then the steps that I walk founders through when they're striving to improve their cash flow and make their businesses more profitable.
Hi, I'm Emily. I'm a food biz strategist and founder of Food Biz School. You may have heard my conversation with Sarah on the podcast this season. Sarah and I are going live inside the Good Food CFO community on Tuesday, January 9th, to answer your questions and continue the conversation from the episode. This live Q&A is available to all Good Food CFO Plus members. If you are not a Plus member yet, you can upgrade by visiting thegoodfoodcfo.com/join. With your Plus membership, you'll get access to live Q&As like this one, exclusive bonus content, and even attend live podcast recordings. You can upgrade to Plus membership for only $12 a month. Just visit thegoodfoodcfo.com/join to learn more, and I'll see you in January.
Chelsea, I don't know what the stats say about our most listened to episodes, but our most talked about episodes, hands down, are definitely the Rethinking Cash Flow and the Pulling Out of Retail episodes. I mean, both of those episodes had people texting, emailing, and messaging us on social media.
Yeah, especially the Rethinking Cash Flow episode. I mean, we had founders reaching out after that episode telling us that it was the most informative episode we had done so far.
Yeah.
And I think what really struck a chord with, our listeners in terms of these two episodes is that, Sarah, you really laid out like a different way to think about finances and doing business in today's food industry.
Yeah, I mean, both of those episodes talked about concepts in ways that traditional business media don't talk about them. And I've said it a couple of times before too. You don't learn this stuff in business school either, right? Like we're taught about how big business is built, right? Think about the Tysons, the Walmarts, the General Mills of the world. Those are the businesses that are the case studies that we learn about in business school and that are written about in business books. But the vast majority of businesses in the US are nothing like those businesses in terms of size, scale, and financing. And that's, I think, especially true in the good food industry. So we have to talk about how small businesses should be looking at and understanding their numbers and using this new financial knowledge to make strategic decisions.
And when you say strategic decisions, I think the common things that would come to mind for founders or really anyone out there are around growth and marketing strategy and like how to get bigger. But you're also talking about how to improve profitability and cash flow, not necessarily growing bigger, but growing smarter and more financially efficient.
Yeah. Our goal here, if it's not yet completely clear, is to create financially thriving businesses, right? Not the businesses with the most revenue, but businesses with the highest profit margins and profit dollars so that they're able to pay their teams and their founders a really good wage, offer a product that otherwise wouldn't exist to their customer base, and to continue to fulfill their missions. And in line with that, today, I want to talk about the price versus margin conundrum that is so very common in the good food space and is also very fresh on my mind after a recent consultation. And I want to also take a bit of a deeper dive into the steps that a founder can take to identify their path to profitability and positive cash flow.
It sounds like this is a great opportunity to dive into some of the tools and resources that you talked about at the end of the Pulling Out of Retail episode.
Yeah, I mean, I was inspired to talk about this further and to do a deeper dive like that after the recent consultation that I mentioned. So the founder in that consult shared that their business was not profitable and essentially out of cash. Right now, there were several factors at play that I'm not going to detail here, but I will share that some of those factors had resulted in a reduction in sales year to date and an increase in cost of goods sold for most of their products. And this is common, right? Like post 2020, 2021 pandemic trends. So they had done a price increase in response to their cost increase, but the increase didn't fully cover the increased cost because the founder felt, like so many do, that they had reached their price ceiling. And this is important to note because increasing prices is one way to improve profit margin and cash flow. But if you're truly at the top of what your customer will pay, that is no longer an option for you. Hence the price versus margin paradox.
Yeah. So what you're saying is that they had a lower product margin than they did before, and their sales had decreased in at least one channel.
Yeah, that's exactly right. And up to the point of our conversation, the founder had sought some advice and they received the typical guidance to, take out a loan or another loan in their case, to find an investor, to maybe give equity in the business to someone and bring on a partner, right? And the other recommendation was to grow sales because the common theory here is that if you grow sales, you'll have more money in the business and you'll be able to cover your expenses and be profitable.
Which we know is not always how things work out.
Exactly. So the founder wasn't really interested in more loans. As we discussed in the news segment today, money is now more expensive than ever before. They weren't interested in giving away some of the ownership of the business. And after being in the industry for years, they know that growth can be slow in the CPG space and it can also be really expensive. So they came to Sarah Delavan Consulting looking for what they called a fresh perspective and ideas on what could be done to keep the business viable, to be able to pay back the debts that they have on the books currently, and eventually be a thriving business again.
Okay, so in this process of, I'll call it like righting the ship, right? It sounds like you are helping to put the power back in the founder's hands, like the power and leverage to build the business that they want to build.
Exactly. I mean, I hope to do that with every client that we have, right? Yeah.
Okay, so where do we start?
Margin, margin, margin. Step one is to identify and understand your gross profit margin. So I start here because I like to take the big picture approach, right? Start wide and then narrow in on the necessary details because it can be super easy to get lost in the numbers and the data. And I think establishing where you are now, big picture, and where you need to be is the best first step for determining if you need to keep digging and then also outlining the rest of your work. I also have come to know that the gross profit margin is really sort of the linchpin, right? And the big determining factor of cash flow and whether you have increasing cash flow or decreasing cash flow. So you can cut costs, you can, tackle other parts of your business, but if you don't have a gross profit margin that is working for you, you won't be able to build a viable business.
Okay, so if I am trying to understand my gross profit margin, right, in my business, is that as easy as like running my P&L report with the gross profit margin showing as a percentage of the revenue?
Yeah, I mean, you definitely want to run your P&L, but most financials are not structured in a way that gives you a proper calculation of your gross profit margin. And this is due to how cost of goods sold can appear on your profit and loss report. So, for example, and this is a big one, production labor. It is typically a significant cost of goods sold. It should be separate from your non-production labor, and it should appear in the cost of goods sold section of your P&L. But I run across financials all of the time that have all of the labor combined, and all of it is showing in the operating expenses portion of the P&L. When this is the case, that gross profit number and that margin calculation on your P&L, it's not going to be accurate. Another example is going to be shipping costs, right? So sometimes shipping costs are not included in cost of goods sold. They're down in your operating expenses. And merchant fees is another really common one, right? These are the cost to process payments for your customers. I absolutely consider this a cost of goods sold, but in the accounting world, it's kept in the operating expense category. So we run into these types of issues, if you will, in calculating gross profit margin all of the time. And it's actually the original reason that we created the profit assessment tool. It allows us to export the P&L from QuickBooks into our custom template and then very quickly and accurately categorize cost of goods sold and operating expenses to get the true gross profit margin percentage for a business, along with a lot of other helpful data. You can review your P&L and use the stated gross profit margin with the percentage if the report is structured correctly. You can also do a manual calculation, right? If your P&L isn't structured correctly, you can kind of break out the calculator and a pencil and do it that way. Or you can utilize the profit assessment tool that will help you to do the calculation.
Also, if you're unsure about any of your costs or like where they should live, the profit assessment includes a COGS reference sheet that helps you determine what is a cost of goods sold versus what is an operating expense, or even for some of those like gray area items.
Yeah, great point.
Okay. So once you've calculated your gross profit margin, how do you determine if it's good or bad? Or, what do you do with it?
Yeah, great question. So when you're looking at a gross profit margin percentage, we're actually gathering insights into its effect on the cash flow of a business and the financial efficiency and viability of a business. So The deep dive into this topic is in episode 56, which is the Rethinking Cash Flow episode. But today I'm going to summarize it as best I can. If you're at a 50% gross profit margin, it means you're earning just enough from the sale of each unit of product to produce one more unit of product. There isn't actually any additional money in the business to cover your operating expenses, unless for some reason you plan on selling less product in the future. Your P&L could show a profit, but cash flow is going to be likely to be telling a different story. If you have a gross profit margin that's above 50%, that means you're generating enough revenue to make at least one more unit of product for every one that you've sold, and you can cover at least some of your operating expenses. And if your gross profit margin is less than 50%, you are not earning enough money on the sale of every product to produce one more unit of product, and there is truly no money available for operating expenses. Still, the P&L could show a profit, but cash will be required from outside of the business to maintain and especially to grow the business.
So the higher your gross profit margin, the more cash you have to pay your bills and to keep producing product or grow your business.
Yeah. And I think it's important to say that truly, there's not really a scenario in which you grow the number of units sold that doesn't require some outside funding from debt or something else. I mean, CPG is a cash up front, get paid way later business. And I want to be clear that the goal is not to never take on debt or invest in your business. The goal is to understand if you have a business that can pay back debts once you take them on, and to build a business that can be cash flow positive and aligned with your personal risk and debt tolerance. So identify your gross profit margin percentage and determine if it needs to be increased, and then by how much. So for example, you may look at your gross profit margin percentage and find that it's 45% right now. And then you may set a goal to increase that above the 50% mark to 52%.
Okay, but how do you know like how much to increase it, obviously over that 50%?
Yeah, another great question, Chelsea. This is going to be specific to the business, but I can give you an example. So let's say that you have a business that's generating $500,000 in annual revenue, right? A swing from 45% gross profit margin to 52% gross profit margin for that business is going to be a 7% change. And that's going to be the equivalent of $35,000 in additional gross profit, right? So you can see how significant that can be to a business. Now, if we dig a little further into it, if we make it to that 52% gross profit margin mark, right? That 2% above 50%, that is equivalent to $10,000 for this business. So if you have a 52% gross profit margin, you'll be able to maintain your unit production and sales, and there will be that $10,000 to put towards your operating expenses. And as you said, Chelsea, the higher your gross profit margin, the more cash you have to pay your bills and to keep producing product or growing your business. So you want to maximize your gross profit while still meeting the needs of your customers, right, in terms of their price point and things, as well as your suppliers and your team.
Sarah, I'm sure that this is like where you're headed, but how do you do this? Because I know that you mentioned using price increases to get closer to that gross profit margin target, but we also know that this isn't always an option.
Yeah, that's a great question and a great point. So yes, sometimes increasing price is an option. If that option is available to you, I recommend that you don't do it arbitrarily and that you work through step 2 that I'll talk about in a couple of minutes here to assist you in determining, which products you'll apply a price increase to, which channels will get that price increase, and how much of a price increase will actually be needed to make a difference in that gross profit margin. Other ways to increase your gross profit margin would be to reduce your cost of goods sold. So this could be reducing the cost of product inputs, reducing labor, or reducing what we call other costs of goods sold. And this is actually another thing I really love about the profit assessment. And that is that it shows you your product COGS, your labor COGS, and your other COGS, which are your shipping and your merchant fees, et cetera, separately. Because sometimes shipping is a major cost that's impacting your gross profit margin. And if that's the case for a business, they can see that and make changes in that area pretty swiftly. If product COGS or labor COGS are impacting your gross profit margin the most, you'll then know to take the next steps in identifying and creating changes in those areas.
Yeah. And what's so cool about the profit assessment is it comes with a decision tree that helps you to think through those next steps based on what the assessment is showing you.
Yeah.
And that allows you to get really customized with your approach. Okay. So let's say I've worked my way through the decision tree, right? Mm-hmm. I've done everything I can to lower my COGS. I even made the decision to raise my price, but now I'm at, what we called earlier, my price ceiling. And I'm still not hitting my target gross profit margin. So now what? Where do I go from here?
Yeah. So for founders that are in that position, the next step, so step 2 in this process, is to look at the product profit margins in every channel that you sell in, and to look at your sales channel margins as well. So you may sell the same product in 3 channels. The product COGS in terms of the dollars and cents are going to be exactly the same in every channel, but the margins are going to be different because margin is based on the sale price in relation to the costs. And because, for example, you sell a product to your wholesale customer for less than a D2C customer, your margins in wholesale are going to be lower, right? So, for example, the client that I've been referencing throughout this episode, their top selling product ranges from 78% profit margin in D2C to 57% in wholesale, down to 46% profit margin in distribution for the same product, right? Looking at each product and its margins allows you to identify which products' revenue are improving or hindering your cash flow. And you want to take note of this. So just like we talked about previously, Chelsea, when the gross profit margin is at 50%, right? The sale of that product is making us enough to produce another unit of that product. When it's above 50%, right? It's improving our cash flow. We have enough to produce another product and then some. And when it's below that 50%, we aren't earning enough from the sale of that product to make one more unit. So this is really valuable information. Then we back out and look at the sales channels as a whole. So the blended gross profit margin in the case of this business that I've been talking about was 47%. So below that 50% mark. And the individual sales channel margins broke out as follows. The D2C gross profit margin was 76%. The wholesale channel gross profit margin was 60%. And the distribution channel is 45%. The majority of their sales happen in the distribution channel. That fact, along with the 45% profit margin in that channel, was pulling that blended gross profit margin down below 50% and causing their cash flow issues. This business, like many, cannot increase their prices in distribution. But the bottom line is, if this business is to continue as they have been, they're going to have less and less cash flow over time, and they're eventually going to have to go out of business. So to prevent that, if you can't raise prices, you must change your channel strategy. You can modify your product mix. You can eliminate a product from the channel or pull out of the channel completely. And you can get creative, right, based on your specific situation. But as I said in the Pulling Out of Retail episode, before you make any changes, you need to understand the impact, right? Will pulling out of distribution mean that will they stay exactly the same? Can you be profitable in that scenario? Would it require growing another higher margin channel, right, in order to have enough money and cash in your business? What would the revenue goals then need to be? And how would you achieve that? Thinking through the possibilities and then laying them out in a forecast so you have a clear picture and a plan for implementation is a very, very important final step.
So Sarah, for any founders that are wanting to, really dig into this work and kind of right the ship, as I mentioned earlier, it sounds like step one, right, is really about awareness and understanding what products or what channels or what are the parts of your business that are lifting your cash flow up and what are the parts of your business that are dragging your cash flow down.
Yeah.
Once that becomes clear to you, then you can develop the strategy necessary to really make that change. And then, as you said, working through all the possibilities to see if those strategies will actually play out the way that, you might think they will.
Yeah. And I think this links directly back to building financial confidence, right? Awareness is like an essential first step, looking at I know the realities of my business in terms of the checking account. I know the realities of my business in terms of what the bottom of the P&L says. Now let's become aware of what the middle says and get an understanding of how that number is having an effect on my business, right? And on my cash flow. And yeah, then it's just that first step. And then you can take the next step to continue understanding what's happening. And I love what you said, like how it's, benefiting or not benefiting your cash flow in your business. And it's such a great way to think about it. There are changes that can be made. Even if you can't increase your price, you aren't stuck. You can make changes. And that first step is awareness, and then just follow the rest of the steps and come to us for support if you need it. We are here to help you. Financial confidence doesn't come automatically, right? And so you have a community of people and in myself and you and other founders who want to be here to support you and watch your business thrive and be successful.
Curious about the profit assessment? The profit assessment is our simple tool that makes sense of the not so simple world of food finances. To learn more, just visit thegoodfoodcfo.com and click on courses.
Thank you for joining us here today. If you enjoyed this episode or found it helpful or inspiring in any way, please share it with your founder friends on social and rate and review the podcast wherever you listen. It's the #1 way to help good food founders find the show. We'll be back with a brand new season on January 8th.